Good morning, and welcome to Market Insight. Is your AI portfolio shrinking while the rest of the market rises? Today, we dissect the financial paradox that rocked the markets. Why did the AI leader, NVIDIA, sell off despite the Fed cutting rates? We analyze the dangerous signs exposed by the FOMC and Oracle's earnings. At the close, the major indices showed resilience. The Dow Jones Industrial Average rose 0.16%. The S&P 500 closed up 0.48%, and the tech-heavy Nasdaq Composite gained 0.92%. However, this bullish movement is misleading. Key AI bellwethers faced selling pressure, signaling a clear shift toward selective investing. Stay with us as we dive deep into the three critical topics defining the next phase of the AI investment strategy. The three spotlights today are: the rate trap. Why did AI stocks sell off despite the rate cut? Analyzing Powell's tone and the Fed's painfully slow timeline. The AI betrayal. Oracle's earnings expose the growth trap. Why is revenue disappointment overshadowing huge AI cloud backlogs? The ultimate shield. The truth behind NVIDIA's secret CoWoS dominance. The supply chain bottleneck competitors can never break. We begin with the core of finance, the Federal Reserve. The FOMC voted to cut the federal funds rate target range by 0.25 points, setting it at 3.5% to 3.75%. This was the third consecutive cut and largely expected, but the devil was in the details. Key point 1. Powell's message and the market's takeaway. Chair Powell stressed that the cut was part of the normalization process, and not primarily an economic stimulus, stating it would contribute to a stable labor market and allow inflation to resume its decline toward 2%. This message managed to curb the market's irrational exuberance for aggressive future cuts. This macro outlook fuels the selling pressure on high-valuation AI growth stocks. Key point 2. The dot plot and the painfully slow pace. The dot plot was the primary source of investor disappointment. FOMC members maintained their view of only one rate cut for 2026. This signals a painfully slow pace of normalization, contradicting the market's expectation for continuous, rapid cuts. The prospect of prolonged higher interest rates, even if rates are falling now, fuels the selling pressure on high-valuation AI growth stocks. Key point 3. The rare split vote. The decision was not unanimous, with a rare 9-3 split vote, the widest division since 2019. Two members advocated for a rate hold, while one member pushed for a much deeper 0.5-point cut. This significant division within the Fed heightens political uncertainty and adds another layer of macro risk, leading to caution among tech investors. Market impact. The resulting takeaway is that the policy uncertainty will be prolonged. This forces capital to shift away from high-beta growth stocks like NVIDIA toward companies that demonstrate strong fundamentals and pricing power, regardless of interest rates. Our second topic is the earnings report from cloud giant Oracle, which exposed a key paradox. Confirmation of AI demand. First, the good news. Oracle confirmed that demand for its AI cloud services remains extremely robust, with its contract backlog exceeding market expectations. This provides solid proof that the AI build-out is a very real, structural phenomenon. The real revenue miss, however, the stock faced pressure because the reported revenue marginally missed consensus estimates. The core issue wasn't the AI cloud, OCI, growth, but the slower growth or stagnation in traditional database software licensing and cloud application revenue. The structural shift. This signals that the AI boom has entered a tougher phase. The structural trade-off. Oracle is sacrificing revenue from its highly profitable legacy software business to aggressively fund the massive capital expenditure, CapEx, needed for AI infrastructure. Investors are now scrutinizing efficiency and profitability over mere demand. This concern extends to NVIDIA and other suppliers, who face questions about the long-term returns on the huge infrastructure investments they enable. Amidst the macro headwinds and profitability worries, AI champion NVIDIA continues to solidify its dominance with a secret weapon. CoWoS, chip on wafer on substrate. What is CoWoS? CoWoS is the ultra-high performance packaging technology that physically stacks the powerful AI chip, GPU, and high bandwidth memory, HBM, extremely close together. This is the lifeline for maximum AI performance, significantly boosting data transfer speed and efficiency. The bottleneck, crucially, only TSMC, Taiwan Semiconductor Manufacturing, can reliably mass-produce CoWoS with the required quality. This makes TSMC's CoWoS capacity the single most critical bottleneck in the entire AI supply chain. Strategy of NVIDIA. Latest observations confirm that NVIDIA has strategically locked down the vast majority of TSMC's CoWoS capacity for its next-generation chips. This means competitors, even if they design a great chip, cannot produce and supply it at scale. NVIDIA is not just selling the best chips, it is effectively controlling the bottleneck for the entire industry. This strategic supply chain lockup is the most potent insurance policy against market volatility and competition for NVIDIA. To summarize, the market is currently battling the macro risk of slow rate cuts and the micro risk of profitability challenges in the AI build-out. The takeaway for investors is clear: don't chase general AI growth. Focus on selective investing in companies that, like NVIDIA, maintain unassailable control over costs and supply, allowing them to thrive even when interest rates remain high. If this analysis helped you re-evaluate your portfolio, please hit the like button and subscribe. Let us know your thoughts and your NVIDIA positions in the comments below. We'll be back tomorrow with more in-depth market analysis. Thank you for watching AI Market Insights.